Welcome. I think people are still having some snacks, nibbles, and drinks at the back, but for all those who are still with us online at this ungodly hour, welcome to the part in which I'm gonna walk you through navigating the credit spread risk in the banking book, the new regulation from the EBA. So what I'm trying to cover here is not only the guidelines, but also focus on understanding of what CSRBB actually stands for in terms of its definition and scope and how it's changed under the new guidance, but also include some practical strategies or items to focus in the future if you want to implement in the future. So this slide I dedicated to the evolution of the guidelines. I think we did cover that. We touched on that main regulation from 2018 during the Claire's part of the presentation. What I wanted to explain here is that the current regulation in place is a continuation of the 2018 paper. However, there are some other milestones in the evolution of how the credit spread risk in the banking book has risen to a bit more significance and importance under the new rules. As you can see, we are quite behind the initial deadline for RRBB. Still, the organizations have time to the last month to implement the changes to CSRBB. Obviously, this is within the EBA framework. However, I think one of the explanations that my colleague speaker explained is that it might not be a regulation that you have to put in place. However, it is an indication of good practice that you may want to focus on. Moving on to the scope and definitions of the credit spread risk in the banking book, I wanted to clearly state what the definition is, because if I were to get $1 for every time I said I'm going to present on CSRBB, and someone responded, "Oh, I'm really into credit risk," I would have probably like $5. So this is the clear definition here that I'm stating in bold, that it is defined as the risk driven by changes in the market price for credit risk, including liquidity. And this risk captures the changes in an instrument spread within a certain rating or probability of default. So without assuming a change in creditworthiness. In the regulation itself, you can see that the bars that are building blocks of what we should understand as CSRBB. So you can see that I included the option for inclusion. What's the option for inclusion in terms of idiosyncratic risk here? You can include those qualifiers or those areas within your CSRBB framework if your assessment is more prudent than just focusing on the two blocks in the dark blue colors. Another thing to consider is that the definition extends in terms of the scope to on-balance sheet and off-balance sheet positions. And also, another element is that obviously there is this credit risk spread risk in the banking book. However, there is also this market liquidity spread element that is one of the factors that you should consider in that definition. So this is the reflection on the funding liquidity risk of the lenders. What I was trying to capture here is that there are key elements of those guidelines, and when you think about how to explain it potentially to your team members or to more senior people within your organization. I think these are quite useful blocks that you can focus the communication on. So there is this element, as I mentioned, that continuity of what was in place or what was laid out in 2018 with an element of expansion. And that element of expansion is that there are dedicated chapters on credit spread risk in the banking book within the document issued a year ago. So it underlines the growing importance of this risk factor in risk management. Also, the fact that it includes all assets and and also liabilities off and on balance sheet, regardless of their accounting treatment, is also a factor that needs to be considered. Effectively, there are no instruments that you would exclude from this framework unless you can state specifically they don't have this element of credit spread risk. Also, obviously, being a risk professional, I did include a bullet on the governance and importance in the strategy implementation and alignment to the strategy. And I'm going to cover that in a bit more detail in the following slides. Also trying to simplify that quite lengthy regulation, I wanted to build out and present the core components of the impact measurement. So obviously the comprehensive measurement approach, you can see that EVE, net interest income, are the factors that are named that should be considered when looking at credit spread risk in the banking book. It is to some degree for some institutions a novelty because this is something that would be much more closer associated with interest rate risk in the banking book, and credit spread risk used to be that ugly sister that is a bit less cared for by the organizations. And I think this regulation, if I were to summarize it in one sentence, that's exactly the opposite. So brings it up to the same level and integrates, which is on there, sorry, I skipped a little bit to the right hand side, integrates the approach for the credit spread risk with the likes of interest rate risk. So obviously you go through the comprehensive measurement, you understand what you have on the books, you know how the instrument works or reacts to changes in the market risk factors. There is an element of validating and reporting of that. So obviously with quarterly submissions, obviously not under our framework, but the EBA, it is allowing to reflect this much more dynamic nature of the credit spread and this need for continued oversight. I touched on that irrespective of valuation effects, this is still, no matter what's the accounting treatment of your assets liabilities, you should consider them within this framework. And I touched on the risk appetite and model integration. If there is anything else to add here, is probably when you think about the risk appetite for the whole organization, it is very closely linked not also to your business model, to the products that you hold, to the size, and the recognition of how you measure and assess should be proportionate to the shape of your organization. So I'm covering more of aspects of proportionality of implementing these guidelines. So obviously the institution's profile should be considered, business strategy and environment, adaptation to level of sophistication and risk. what it means in the real world situation. I do get, because I work for risk and regulatory advisory company, besides being BTRM faculty, I do get quite a lot of questions around the lines of, we don't think we have credit spread risk in the banking book, so what do we do about it? Firstly, I would really challenge that assumption. I would step back and think about, is it on off balance sheet asset liability? Are you absolutely convinced that you don't have this element of risk on your books? Secondly, if that exercise was done, so it is important to communicate it upwards in a very clear manner. So don't omit it, don't skip that chapter in your regulatory submissions or in your MI that you provide to the board. Just give a clear example of, we've gone through this exercise, we've done X, Y, Z, and therefore we believe this is the number that we have and that number is 0. So just don't exclude it from the communication that you have with the senior stakeholders of the bank. I also did here a slide on how to embed the governance and strategy of this particular risk type within the institution. We touched on identification of and classification. So coming back to understand your products, understand what they do in different environments. I had this interesting discussion just before we started around, it was specifically to interest rate risk, but I think it applies here as well, that some of the risk factors are like a sleeping tiger. You know that it's there, but you disregard it for many years, and then suddenly it does appear and attack you. And then everyone with the benefit of hindsight is posting on LinkedIn, making lots of comments of, this is why this or that failed. You don't want this to happen. You want to be ahead of that event and be aware of it. So obviously, if someone comes back to you and says, well, actually, this wouldn't have happened if X, Y, Z, if you had thought about it, then it might be right to some degree. Have you ignored a factor that was not visible because the market environment was so stable over the past years? And it applies to a multitude of other models where over the last decade, if you plug the numbers that you have into your models, they might not yield very volatile results. But is this still the case if markets become more volatile? And we've seen a bit of that volatility over the past year and a half or two. Another factor is that alignment with IRBB management framework. So no longer the ugly sister of IRBB, but more friends and family. The next one is, I called enhanced focus on diversification and validation. And what I meant here by that is the diversification with other risk factors. So truly understanding that none of the factors that you have, we focus here on credit spread risk in the banking book, in real life, it does not exist in isolation. You have products that have price that depends on multitude of risk factors. So thinking about it as a building block or a separate or part of some situation is not the right approach. You have to have this holistic approach of fully understanding of your balance sheet and of the products that you offer to the clients and how they respond to those products in the environment of change to the rate, for example, to the rate environment. I did cover the risk appetite definition. Obviously, there should be some form of risk appetite statement dedicated just for the credit spread risk in the banking book. If you say it is a 0, I would really strongly encourage you to include why you think it's a 0, and backing it with analysis, research, and communication, just to be able to validate. Don't skip that chapter in your communication with both the senior stakeholders and the regulator. Obviously, this environment that's rapidly changing. You get you get different levels every single day. So obviously, ongoing monitoring of the situation, forecasting, making sure your models are updated to reflect the current environment in your assessment, challenge your assessments regularly, are all examples of good practice. Also, proactive control and mitigation measure is an extension of that. So obviously know what it's going, but also think about what can you do about it if it happens. So if I were to do the blocks of the key takeaways, obviously there's on a couple of occasions I underlined that there is this dynamic element of risk management, and it is not only due to the fact that someone comes up with a new regulation, because you don't have to be reactive to the change when it's due, when you're required to actually put it in place. You have to be reactive to what's happening in the market, because this is what you're connected to. You work in an organization, you have probably in Treasury this almost holistic view of how the market links with both assets and liabilities of the institution you work for. So you should be fully aware that it is not static. So using assumptions from 5 years ago, probably not valid anymore. So challenge those, think about the big picture. Strategic integration and adaptation to whatever guidance there is to the changes in the market factors. Also key. And also, so this is the block that I included, just so that if you have to explain what this guidance is in one sentence, probably you could use that block. So it is a very clear emergence of credit spread risk in the banking book as a separate risk category. So everything that I've said so far, it was time a bit wasted. I could have just gone to this slide and told you that. And also, obviously, you are here, and I think you're making the last building block of the good practice, or something you should consider. It is continued learning and development, so that you are aware on one side of the guidance, but also why this guidance is in place. Because now, hopefully, and this is what I strongly believe as a risk and regulatory professional, the regulators don't come up with rules without significance behind them. So obviously, I can hear someone giggle. I'm being optimistic, Morat. Morat says he agrees. So hopefully that's the case, but obviously you don't want to be in that position where something happens in the market, your organization or institution goes down, and you are in the newspapers with everyone saying, they should have known that. Oh, if I was working in that organization, it would not have happened. So I think one of the factors, keeping up to pace with what's happening, both in the regulation and also the market. So don't forget that link. And I think this is the last one. So actually, this is not the slide that I'm author of. However, I found this really useful chart on the European Banking Federation paper, and it was so good that obviously with explanation where I took it from, I pasted it here. I find that it's a very good visual explanation of what's sitting in the credit spread risk in the banking book versus what's not. So if you're looking at those assets and liabilities that you have on the books, and this is the type of funnel exercise you can probably go through and decide if it is within this framework or not. Yeah, okay, I think this is it for me. And now Morad to the microphone.